afternoon and welcome to the Rust Belt Apartment Podcast presented by the Cooper Multifamily Team, where we discuss all things apartments with a focus on the Midwest's Rust Belt region. I'm your moderator, Peter Graylis, and as always, I'm joined by my co-host and teammate, Gary Cooper. I'm pleased to welcome today's guests, Bhavin Patel and Michael Smith of Green Harvest Capital. With over 40 years of combined real estate and management experience, Green Harvest's niche is 1930 to 1970 workforce housing with value-add components, allowing the guys to make improvements to provide a better living experience for their residents. Since January of 2020, GHC, as we affectionately call these guys, has acquired nearly 700 units and has an operation now that supports nearly 25 employees. Bhavin and Michael, welcome to the Rust Belt Apartment Podcast.
Fantastic. Thank you for that introduction. I can't imagine to be any other place right now than with you guys. Thank you.
Laying it on thick this early in the conversation. I like it.
Thank you very much for having us.
No problem. It's our
very
pleasure.
excited to be on this. We genuinely have a lot of like-mindedness in the way we feel about our region and where we do business and live. And we're very excited to share our point of view on our marketplace, where it's heading, and kind of understand the way you see it also.
Yeah. And before we jump into sort of the bulk of our conversation, and like you said, exploring a little bit about what Northeastern Ohio and especially workforce housing has to offer, your name is starting to come up quite a bit from folks, and they're like, who are these guys? So maybe if you want to tell our listeners a little bit about, where you're from, where you grew up, where you went to college or educated, what your background was before you became Green Harvest Capital.
MJ?
I'll let you start, B, and then I'll add the color commentary.
Okay. So I was born in India. The family moved here when I was 9, and I grew up in Talmadge, Ohio. Went to Akron U for my undergrad, and Ashland University for my grad school, and very much Northeast Ohio focused. I presently live in Bath, Ohio, with my 2 daughters and my wife. And, started in real estate very early. Was fortunate enough to stumble into my first acquisition when I was a sophomore in college. And, true story of just asking. And there was somebody that had a need. I asked if I could work, and they said absolutely. And that led to landing a contract for the business, which gave the owner comfort to sell it to me on a land contract, which happens once in a while. And that was my introduction to real estate.
Okay.
Since then,
yeah, you got a little bit of the Sam Zell story.
Yeah,
that's how good old Sam started out. So
really,
yeah.
That's
how, in fact, your story is, whether it's Doug Price and Karen Pagnini, or some of the biggest owners in Columbus, it's a little bit of the same sort of story. They started out early, they started out small, and were able to grow from there.
Yeah, and so, at present with Green Harvest, we operate in 3 counties: Stark, Summit, and Cuyahoga. We look forward to continuing to acquire in this region. Our thesis is based on 1930, 1970 construction value add model. We're long-term holders. We like to buy in this region because we see an upward mobility in it. That's a little bit about me and what we do.
Fantastic. Michael, now actually, before Michael jumps into his background, you guys are neighbors.
I was hoping that would not come out, Peter. But here it is.
You're truly neighbors, correct?
Yeah, we are truly neighbors. And a funny story there, we were talking to one of our lenders the other day, and she paused, and there was kind of this awkward moment, and she said, "You guys live together?" Because we literally do live on the same street. So we joke about that a lot. I have to drive by Bhavin's house every day, and on the weekends, I'm always thinking about him and the company. But yeah, I started my career in real estate. I actually started as a civil engineer, construction manager for Exxon on the West Coast. I was part of the group that we built gas stations.
Okay.
To me, that was a great job. I really enjoyed it. The idea of building something and making a corner better was very attractive to me. Over the course of my career, I kind of moved away from real estate, moved into more management consulting, with some bigger companies, but always was hoping to get back into real estate, and started talking with Bhavin, just, in the neighborhood, right? Having neighborhood street conversations with our children in tow, and the rest is history. So you had mentioned, Peter, we did our first acquisition was in early 2020, but we actually had been at it for a couple of years prior to that, swinging at deals. And we call it, that was our education. That was our graduate education in trying to find multifamily in Northeast Ohio.
Fantastic.
So did I hear that right? You were neighbors first before.
We're getting a little Zoom feedback here, gents.
Can you say that one more time, Gary?
Gary, one more time. I think we lost you a bit. We may have lost him. He may be freezing on us.
Can you guys hear me now?
You're back. You're back.
Okay, great. Went into the thing. I just asked. So if I heard you right, you guys were neighbors before you were partners.
Yes,
that's correct.
That's even more interesting, I think, than somehow you guys got hooked up, were operating a company together, then sort of moved relatively close to each other. But as you said, Michael, that you guys been at it for a while, even before Green Harvest. I'm going to take maybe B back 10 years, 12 years ago, maybe 2012, 2013. That might have been the first time I met you. We were touring some properties down in Canton. Green Harvest was still a dream of something that you were going to be doing. And, obviously, I think at that point you just owned it. You were in the extended stay hotel business. And obviously the fracking and shale boom down in Canton and in Ohio was going on. And you were looking at, multifamily, because it's like, my God, the only time I lose somebody from extended stay is because they're going to an apartment. So you want to tell us a little bit about your journey from, obviously, I don't know if you were completely in the hotel business or how you got into that, and then how that sort of morphed into multifamily.
Yeah, I think you described it very accurately. My first acquisition was a 27-unit apartment complex that was ran as an extended stay hotel. And like I was saying earlier, it was bought on a land contract because the owner saw in me the ability to make the payment for 6 months, because I had landed a large contract with a construction company that was trimming trees for the electrical contractor in the area, AEP. And so that was the foundation. When the fracking boom happened, we had a lot of influx of individuals from Louisiana, Texas, and they were all staying at the hotels, taking our apartments, and then moving on to other multifamily. I was in Louisville, Ohio a lot. And in Louisville, Ohio, Chesapeake Energy was headquartered, and if you were understanding oil and gas, if you wanted to understand the Utica Marcellus shale play, you'd go understand Chesapeake Energy at the time. And that's where we acquired our first multifamily, a 24-unit townhouse development. And, the rents were $495 a month. The acquisition price is out there. It was $30,000 a door. And it was a very unique experience to understand how units were rented on a 12-month period, how for about a 10 to 15-year period, the 80-year-old owner had operated at $495 a month in rents. And it was very unique how the rent was collected, trying to understand the mindset of the older generation gave me I saw a lot of opportunity in that. We looked at median household incomes at the time, in the high 40s, low 50s. Understood that multifamily nationally would have a 30% income ratio, where if you made around, let's say $52,000 as a household, you would spend somewhere around $1,300 a month in rent. And most of the tenants made $50,000, $60,000 a year, yet the rent was $495. And so then the model was, okay, what are the desirable things that the tenants want, need, amenities? Yeah. Obviously we couldn't put a pool in, yet there were so many things that we could do. One of the early programs that we implemented were LED lights. We went in and for us and our tenants, exterior, interior, at no cost, we would replace every light bulb to LED bulbs. And toilets were $125 a toilet, project source from those. Yet the older toilets were taking anywhere from 5 to 7 gallons per flush, where you could reduce that consumption dramatically by a 2-gallon flush. And so we implemented those. People saw quality of life improvement instantly. We had some older tenants that were paying $125, $150 a month in electric bill. All of a sudden, they were paying $30. And that was a dramatic shift to somebody living on a fixed income. And so we saw an NOI improvement. Within 6 months, we took the annual rent, which was around $8,000 a month, to almost 12. And at the time, an 8% cap rate in the market was terrific because I paid 10. And my banker said, "Oh, if you keep this up for another 6 months, that's $250,000 more in value." And I thought that was astounding. And that was around the time that MJ and I started speaking about kind of scalability of this. And MJ's background, not to speak for him, but very much process engineer, management, project management. And I was more the entrepreneurial touch feel, kind of understood the boots on the ground approach. And the combination of the two is what led us to say, if we had the process and the project management and we combined it with the ability to intuitively understand the market, we could scale this. And this opportunity that's here now is going to continue through 2025. Because at the time, our government was deciding to shift from coal generated power to natural gas generated power. Yet, because of the Keystone Pipeline not coming to fruition, all these midstream infrastructure pipelines had to be built, and the fracking boom was going to have a resurgence closer to 2025. So we saw this 10-year runway where we could go out and do acquisitions, and we hoped and prayed for inflation in 2025 and beyond, job growth, job creation through this. And we were pleasantly surprised during the pandemic, where we were positioned to have vertical integration, to have a proven thesis, and see rent appreciation and take advantage of the circumstances that kind of were driven by it.
Gary, I'm really glad you asked that question, because I think it, as Bhavin spoke, right, it reminded me that really he proved out the green harvest thesis on a smaller scale, right? And now we're using his lessons and his experience at a bigger scale. By the way, if you have an issue at your house, a plumbing issue or an electric issue, call Bhavin. He's the guy. I mean, he really knows these things.
Well, when we walked Michael Towers, it was apparent.
Yes,
you guys both know your buildings, which I think leads to success. A lot of folks think they don't need to know what goes on in an apartment building, and oftentimes they're in for a rude awakening.
That's sort of an interesting thing, right? Is that I believe at this point you're still using third-party management, but you guys are not the typical third-party management client, in the sense that you are very involved and actively engaged at your buildings. I know you guys do a lot of the rehabs yourself, a lot of the turns yourself. And, even though you haven't completely built out the management structure, you're certainly on your way with some of the hires that you've made and some of the obviously high quality people you've added to your team. But can you talk a little bit about, again, is Northeastern Ohio, can your model work completely under third-party management, or how management intense do you believe Northeastern Ohio to be?
Yeah, I'll take this one first. Absolutely, there's some terrific management companies in our market. Our model and other models can work as long as purpose and intention are aligned, right? I mean, we're true Northeast Ohio guys. We live here. We're building a business where we support our communities, right? And so we improve these assets to be long-term holders. And I think that's important. A lot of firms, when they look at an exit strategy, whether it be 2-year or 5-year plan, that leaves a lot on the table, right? When you're solely focused on the bottom line, because these older properties take time. I mean, especially for us, we're creating communities, we're building a better life for people, we're delivering a fair return for our investors, and all of that takes time. And so I think you can do it with third party. For us, because we're a long-term mindset, eventually we will get there. It's very important for us as owners to what we say, be in the weeds, because we want to, be proactive, not reactive. And in order to do that, we have to understand, who are our tenants? What are the opportunities that are there to better their lives and to create other streams of revenue for us? We're looking at multiple things right now that help improve connectivity for the tenant, build a fiber backbone, provide wireless internet throughout the property, internet of devices, and things like that. So that would be my viewpoint on third-party management and why we're so involved.
Anything to add, Michael?
Yeah, absolutely. I would just say that, through our arc of growth, there's been several people that have been and groups that have been very instrumental in our success. And one of those has been our third-party manager. And we've had some real key advisors along the way. We've been fortunate enough now to bring some of those advisors on as employees. And so we're ready for that next step. And I think we're ready, to stand up our own management arm very, very soon.
It's exciting.
Well, I think that's really sensible, because again, when I've seen people make mistakes, they just grow too quickly. And they just, again, their eyes are bigger than what they can actually handle. And then they lose track of the details and all these great things that they thought they were going to do to these properties, because they just don't have the time or the bandwidth to do that. So what's impressed me so much about your group so far is again, that you're really focused on a niche. Right? It's like, hey, workforce housing of a certain variation. This is not just, a lot of people growing, it's like, man, they will buy anything and everything. Doesn't matter the location, doesn't matter the size, A class, C class, whatever. They're like, I'm a buyer, if it's a deal, whatever that means. You guys have a very different, sort of profile in what you're looking at in terms of, the asset quality, the asset locations. I want to talk a little bit about that, because again, it's a little bit counterintuitive. We're a workforce housing specialist, brokerage team. You guys are sort of a workforce housing specialist, ownership and management company. But, what does that mean to you guys, and why that market, versus other segments of the market?
We're aligned in so many ways with you guys, but yeah, we talk about this all the time in terms of staying in our lane, right? We've had opportunities to go into other markets, and at this early stage in our growth, we really felt like Northeast Ohio, and for us, that's really from Canton to Cleveland. Okay. There was plenty of product that we were looking for within that market, that we could stay close to home. B always likes to say, right, we like to be able to drive to one of our properties in 1 hour. And, I think that staying, true to that criteria has been very helpful in finding additional deals. Right now, brokers, investors, everyone is aware of what we're looking for. And I think because we have stayed so focused on that, it's helped us in a lot of ways.
It probably helps you uncover opportunity when folks know exactly what is in your wheelhouse.
Yeah, and I think, Gary, a very prudent point you made, right? We don't want to grow too fast. We wanted to make sure that we were walking in step and understanding, one, the construction style of the buildings we own. We always say this, right? There are 5 variables that we look at, right? Roof, foundation, HVAC, electrical, and plumbing. If 3 out of 5, and we give it an A through, just like school, right? Okay. A through F. And so we give it a grade, and if 3 out of 5 are bad, or they get a failing grade, and we get into arguments as what's failing, what's not. And if we do, then we don't do the project, right? It's kind of a rule of thumb thing for us, because we've seen the cost component. It's helped us, being in our lane has helped us understand fuses versus breakers, right? If you have Federal Pacific or you have Zinsco breakers, right? We kind of comprehend that our style of construction, we're going to face these certain challenges. And then we can hire individuals that can help us with boilers, for say. We have one individual that's part of our team, specializes in boilers, because again, as time goes on, the outside vendors are becoming more difficult to track down, parts are becoming more difficult, and then that helps us control cost. And so understanding our buildings is the reason. Also construction quality, right? We look at, I mean, for whatever it's worth, right? New construction's terrific because there's almost, zero operating expenses. It's everything is very, friendly when it comes to like consumption, right? And that, but
it's very green. Yeah, right.
very green. But the older properties were built to last. And that's how, I remember early on in my career, I was talking to an owner and I asked them, I won't mention their name, but I said, why do you buy 100-year-old buildings? I mean, like you got all these problems that like are one off. And he said, well, when I was growing up, my father taught me that it took over an hour to 2 hours for the fire department to reach the building. So they had to build it in a way where it would withstand the fire for an extended period of time. So everything in it was built to do that. And so if you look at, a building now, it's not built to withstand a 2-hour fire, right? And so that was one of the touch points why we looked at buildings that were built in the 50s and the 60s. They were built extremely well. And a lot of the technology that we can incorporate, really helps us establish the green side, like LED lighting, really dramatically decreases consumption, low head shower head spigots, low flow toilets. If we have to redo water lines, PEX water lines, right? Things like that have really kind of given us a strategic advantage. We look at flow valves on water lines to understand consumption per building. We buy these things called freeze kits that can help us freeze a line so we can replace a valve instead of trying to find a shutoff valve to the building. Just giving you guys examples of different, technologies that we're implementing that help us really kind of still get the benefit of a new construction, yet the quality of the old construction.
Now, the most famous term in real estate now, and probably the most overused term in real estate right now, is value add. Not sure exactly what that means because it means something different to everyone. But would you guys consider yourself a value add investor? Is that what you do, what your model is built on?
Yeah, I think our model is based on, finding workforce housing that needs attention, needs some love. I like to say that is a perfect fit for us because then we can go into these sites and really put our personal touches on the capital expenditures that we put into them. We typically break it into 3 buckets, right? We're going to do interior upgrades. We're going to do exterior upgrades, which are new lighting, new security cameras in some situations, really focus on the landscape, really beautify the property. And then the final one is the green initiatives that Bhavin laid out. Of the 700 apartments that we have in the portfolio currently, B and I have walked every unit. So we physically like to walk the units during due diligence and really get into the weeds and understand so that we can explain to our stakeholders, be it the lender, be it the equity space, how we're going to improve these assets and the timeline in which we believe we're going to do it in.
Fantastic. Well, yeah, and I agree with you. And I think, again, having that narrow scope and sort of understanding your market, what we're seeing is sort of the blending of different real estate types, right? What used to be industrial is now retail. What used to be, hospitality is now multifamily, and some of the great trends from that, and obviously we focus on multifamily. So the trend, you're seeing, certainly in the new product, the blending of hospitality ideas with the multifamily ideas, not necessarily that they're rented as a hotel would be, or but again, features and benefits are very similar. Do you see, again, since you're buying the workforce housing product, you don't have some of those attributes. How do you think that influences your community? Is that something you're trying to add or blend in? Because people at the very high end have choices on everything, right? People on the low end, as a very prominent property manager we both know, said, hey, folks at the workforce house, they don't get a lot of choices. They don't get to make a lot of choices. So, what does Green Harvest look at in terms of that?
One thing that comes to mind, Gary, is, and not all of our properties fit this criteria, but we definitely look to invest in walkable neighborhoods, that is a natural, amenity right there, right, for our tenants. Bhavin had mentioned this prior, we're truly trying to improve these assets, right? And therefore improve the community in which the asset is in. So if an asset is in a walkable neighborhood, a charming neighborhood, that really appeals to us. And I think, that has, proven to be, tenants see that, right? Tenants that appeals to existing tenants and prospective tenants. And I should actually add, we don't look to force people out of our communities, right, through these upgrades. We do these upgrades when there's turnover, the natural turnover in the apartment. So typically 25 or 30% of an asset is turning over each year. And that's when we're doing most of the interior upgrades.
Well, and you make a clear point on your site that your upgrades also take into account livability and affordability of your tenant base, which, utmost respect.
And I, the hospitality comment was very poignant. We try to think we're tenant focused. And in workforce housing historically in our market, that wasn't always the case. And so we definitely look at it that way. We're in the very early stages of IoT devices being everywhere, in and outside of our buildings. We have worked with Spectrum very closely to build out mesh networks at certain properties where we have access to fiber, where we can provide a 300 megabyte backbone for our tenants, upload and download with a 2 gig dedicated circuit. Wow. So we have broadband wireless internet throughout the property, with a hope of, we're going to install flow valves on our water lines that can help us measure the flow rate and leaks. So if a maintenance person is inside working on a toilet, on their iPhone, they can pull up the flow valve to the building. And as they repair the leak or as they stop the toilet from running, they can see the flow rate go to 0. If we can look at it over a building to building comparison, we can understand consumption of one building versus the other building. We look at safety security, where the front door entry, if you go to hospitality, if you go to any Marriott or Hilton at the moment in any major city, the app will unlock your door, right? Mm-hmm. So as we look at our property management softwares and AppFolio Plus, we look at the ability for our tenants to be able to unlock their door within the next 24 to 36 months, right? Control their thermostat. The second generation of appliances we'll buy will be all connected. Dishwashers, stoves, refrigerators. And, we joke about blinds, right? One of my things is I want people to be able to open and close their blinds with their phones, and IKEA and other many.
Yeah.
That's as an amenity. And then we think about these things as Class A amenities. What if we have the backbone, if we have the connectivity on our sites, we'll be able to implement this and give that quality of life to our tenants.
Bhavin reminds me that 80% of millennials have pets. So you can fact check us there, but I don't know if it's 80%, it's a lot, right? Wow. So that is, Gary, I didn't do a great job of answering your question before, but that is another amenity that we look to put in, right? The dog parks, doggy spas, right? That kind of thing we can add to our sites. It's not a huge expense, and it's a big amenity to a lot of people.
Now, and you haven't seen that in the workforce housing model switch as much, right? You can go to the nicest apartment building in downtown Cleveland, most expensive, the Lumen, right? It's more than dog friendly. There's dog parks, dog washes, they have a dog spa there and everything else, and do that. But then you go to a typical apartment building in Parma or Euclid, and they're like, oh, no pets. And it's like, are you kidding me? This is 2022. And as you said, your tenant profile, the tenant profile you want to go after has that. So I think, again, adjusting to to new trends and new ways is super important, because that's the thing that's missing in workforce housing. It's like, we've done it this way since 1950, so we're going to keep doing it that way. And you always hear me joke, and it's like, half the buildings you go on, I'm like, the guy thinks it's still 1988. In terms of the core, in terms of technology, in terms of everything. So again, I think, what you're talking about isn't unique if you were doing Class A. because it's just, standard operating procedure. I think what you're doing in the neighborhoods that you serve is pretty special.
We appreciate that.
Thank you.
Again, it goes back to, it's not always the bottom line. We're long-term holders. We genuinely want, to be part of these communities for decades to come. So we're investing in them like we would like to be a part of it. And we genuinely believe, it's like, it's all both. If we can get it right, others can see it. And then, it improves quality of lives for everybody.
Yeah. Now, I think you guys attribute a lot of your success to the different, people you've partnered with and the different team that you have, in terms of your advice that you'd give to other investors here. Obviously, you built a pretty strong team in the banking, the legal side of things, obviously in the brokerage community. I want to talk a little bit about those relationships you formed and again, how important those have been to your growth.
I mean, instrumental. I mean, the absolute most important, aspect of our success is all of the individuals that have helped us within our market. We'll give you guys some names. I mean, Walter Haverfield is our legal counsel. Nate Felker and Ted Motherall, true partners from day one. Believed in our vision, always supported us. Very clear line of communication. Absolutely the architects, right? I mean, they helped us understand a lot, out for us. Down to our management, Chuck Schulman at Carlisle Management, an advisor, a friend, a mentor, all of the above, very instrumental. Markham is our CPA. We work with Skoda Jr. and Chris Savak. Again, very much great advisors, friends who continue to guide us to make, strategic decisions. And from an insurance perspective, John Mark at Oswald, we work with them to kind of understand general liability and the entire vertical of insurance needs. A friend, a person that's a great advisor of ours, a connector. So, I mean, these are some highlight ones. MJ, am I forgetting anybody?
Well, the two other people on this podcast, right?
Yeah.
Have been instrumental.
There you go.
I'd also like to say, organizations, the local apartment association, Bhavin sits on the board and on the executive team.
Fantastic organization. Sure.
Yeah, truly. And really took us under their wing before we had any sites, right? So I can't say enough about that group and its support in helping us grow. So we're very honored, flattered, pinch myself every night, so happy what we're doing, and so lucky. We're very, very lucky.
We're fortunate. I mean, MJ, makes a great point about NOAA, Northern Ohio Apartment Association, and again, that's not a strategic partner, but a tremendous group, wealth of knowledge. It's the intersection where the apartment business meets. And if you're an owner and you're not part of NOAA, I think it's a detriment because they allow you to understand, who the vendors are, who the property management companies are, and network with individuals that are very like-minded. So we're very fortunate. Ralph McGreevy runs that organization. Terrific group.
Shout out to Ralph. He's got an invite to hop on the podcast. Let's hope it happens this year. It'll be a doozy. We know that.
I'll remind him next time.
But yeah, I can't say enough about NOAA. A fantastic.
The only thing we didn't chat about in terms of the advisors was a little bit of, how do you finance your deals? Obviously financing for sort of workforce housing is a specialty sort of thing. And it's great that sort of Fannie and Freddie have jumped on board and sort of understand our market better than they have in the past. And I think you have a lot more options today to finance workforce housing and especially do improvements. But what is your typical, when you're doing acquisition, do you guys have an acquisition line of credit? Do you guys use, bridge financing? What does that look like in, using multiple vendors for that?
It's very deal specific, right? The cap stack for any project will be determined by many various factors. Individuals or firms that will look at Marcus Amilichap, Brian Stulak, he's local individual, very high aptitude, lots of access to different buckets. Aaron Massara at Blue Mark, who you've had, Steve
Yeah.
Shern from Mettinger, great guys, good friends, and understanding the plethora of lenders there. And so I would say like those two entities are our conduit. But then the placement can occur anywhere from a community bank, which we have many relationships with, to life insurance companies, to the permanent market, Freddie, Fannie. Just depends on the time and the project, honestly.
Got you. Are you guys big long-term debt guys, in terms of, 10-year, or again, getting you mentioned Aaron Massara and obviously life insurance companies where you can get a, full-term deal, that doesn't expire or balloon in 10 years or whatnot?
Again, it's deal specific, right? We will look at all debt options when they come up. Aaron's terrific at giving us the best option, and they'll go to anywhere from 10 to 100 different lenders depending on the project size and then the location, and then we'll tailor it to that asset.
Makes sense. Have you guys done anything with HUD? Or have you looked at HUD?
We have, but we have not done anything yet. I think it's a very detail-oriented process. As we become more seasoned operators, we definitely will look at it.
Yeah, just
great option.
35-year, 40-year terms, which is insane. And the interest rates are still insane at this level, even with the interest rate increases.
Absolutely.
In terms of, do you guys, obviously you're trying to upscale or again, do some of the things you do at your property. You guys still take Section 8 or some of the different voucher or community programs in your buildings?
We do not seek that out, Gary, but there are situations where we've acquired a property that would have a historical Section 8 tenant, but that's not something that's really in our wheelhouse.
Certain jurisdictions, certain cities, where housing has a voucher program along with it, we absolutely meet those criterias, for affordability and things like that.
Now, you're born in, or at least live here in Cleveland and invest in your capital here in Cleveland. What is it about Northeastern Ohio? I mean, why not go to South Florida? Why not go to Atlanta, Georgia? Why not go to Phoenix, Arizona, where we got 1.5 million people moving here? What is it about Cleveland that makes it attractive? Because right now, let me give you just a quick stat. So if you go back, and this wouldn't, basically would have ended last year, but if you looked at the 18 months prior, basically ending in December 31st, 2021, 90% of the transactions and investment volume went to folks from New York, New Jersey, or Philly. Yeah, that's an incredible control of the marketplace. Now we've seen, since really it sort of started happening in the second half of last year and the first half of this year, it's been dominated by local buyers and folks like yourselves, Mike Gibbons and other folks that have sort of bought properties here in Northeastern Ohio. What is it about Northeastern Ohio that you wanted to invest here, as well as, again, from a fundamental aspect, not just because, hey, you can drive there in an hour. That's not a good reason to invest, right? A good reason to invest is, hey, it's great that it's within the hour, but what are the other fundamentals? Because again, I think you guys are terrific. I don't even know how to put it. PR for why invest in Northeastern Ohio.
Perfect cheerleaders for Northeastern Ohio.
Yeah,
for sure. Well, I'll start and I'll let Bhavin bring it home, but I thought about this because I thought this might come up, and so I was trying to think, well, I need to have a David Letterman top 10 list to answer this question.
Yeah, there you go.
I narrowed it down to 5.
Okay.
So number 1, very livable, right? I've had the fortunate opportunity to live all around the country. I've lived on the coast, I've lived overseas, and I've been in Northeast Ohio for over 20 years now. I find it's a terrific place to raise a family. It's extremely livable, easy to get around. Number 2, it's affordable, right? Your dollar is going to go further in Northeast Ohio than some other markets. Number 3, healthcare hub, right? It's funny. We had some stakeholders with us yesterday from Michigan, and it came up that one of the individuals comes to the clinic every year to do his executive physical, right? And he seeks out the Cleveland Clinic because of that. And I thought about that, and I'm like, I know people all around the world come to Cleveland, but we're really blessed to have such a terrific healthcare hub. Number 4, Ohio and Northeast Ohio, I think, are good for business. I think we're seeing that recently with the Intel announcement to come to Ohio, with the Ford announcement recently, manufacturing electric vehicles here. So we're very, very lucky in that regard. Number 5, for us, there's a lot of assets that meet the criteria that we talked about before. So for Green Harvest, it's a great marketplace.
Well done.
I mean, MJ took grade 5. Only thing I would add to that is, look, we genuinely believe in the revival of the Midwest, the heartland. We're fortunate to be alive in this time. We have a long-term view of resurgence of manufacturing, right? The revival, the affordability side of our marketplace. And we believe that we're in the early stages of it. As through 2025, 60% of our power generation comes from natural gas. The one thing we have to understand is logistics. We're an Eastern Seaboard nation. 70% of the population lives in a 9 to 10 hour circle of Ohio. So in the United States and Canada, which is a ridiculous statistic when you think about it.
That is ridiculous.
But
yeah.
we're 13 colonies, right? And then we went out west, but we kind of stopped right about Chicago. and so as we look at, where the consumer is, when we look at large distribution centers, like a 2.5 million square foot distribution center in Akron, Ohio, when typically it's 800,000 square feet, Amazon is very strategic in that, right? So as oil and gas over the next 3 to 5 years, kind of the pivot occurs to natural gas production, the fracking will happen in Pennsylvania. There's some very large petrochemical plants that are being built in our region. And then, I'll start with Royal Dutch Shell has built the largest cracker plant, which is a polyethylene production plant in Pittsburgh, Pennsylvania.
Near the airport. I sold a property 10 minutes from there. And, when you drove by, when they were building that, it was just, it's on 1,000 acres, and it's a multi-billion-dollar project.
$6 billion project.
Yeah. Wow.
The largest of its kind in the world. The entire global R&D for Royal Dutch Shell now is in Pittsburgh, Pennsylvania. Now, I'm not talking about Pittsburgh because I'm a Cleveland guy.
Yeah.
We have a cracker plant, not as big, 1 to 2 billion, in Scioto, Ohio. We have another one in Kensington, Ohio. In Belmont County, Ohio, there's a company called PTTGC out of Thailand building the second largest plant in the world there, which is not that far from here. So when we see investments like Intel, which is a $20 billion plus investment, the largest semiconductor factory in the world, we're literally picking up Taiwan and moving it to New Albany, right? The ecosystem for that. There was a terrific article in Cleveland. Was it Cleveland or Cranes? I can't reflect, but it said 44% of the suppliers for Intel at present are in Northeast Ohio. So that's where we see the value. That's where we see the workforce. That's where we see the resurgence. And we're willing to bet before it happens that this market will see it.
Well, it's going to become very expensive to make that bet after it happens. So, I think there's a lot of organic value that can be built up. And, we've seen some phenomenal rent growth, and I know you guys have seen it in your portfolio. And it's more than just the value add or we upgraded units and stuff. It's just, true rent growth that's happening even without the upgrades and so forth. And I think a lot of that has to do is, people are like, oh, are we going to fall back or whatever? It's like, no, we're just catching up. We were so far behind the curve, as you said, for so long. Our runway for this to continue is much longer than a lot of other markets that, really weren't as stagnant as what we were.
Absolutely. We agree with that.
We agree with that 100%. We've also seen material costs go up, right? And that impacts what we can do on a site. But I honestly think, labor and rents are at a new baseline, right?
Yeah.
Maybe materials will trim back a little bit. I was speaking with one of our fence providers, vendors, and he said, aluminum for me has gone up 60%. Steel, on the chain link fence has gone up 150%. I mean, we've seen movements of around 50% on, appliances and things like that.
HVAC equipment. Yeah, no, it's insane at the level. And, and again, I think that's going to continue for a while. So much for transitory inflation. Speaking of that, in terms of, people before were looking at, hey, a value add deal, and they were saying, oh, geez, an upgraded unit is 3,000 to 5,000. Is that now 10 to 15,000 because of price increases? And also you've got to do it to a little bit higher level because everybody's doing something like that.
That's accurate. That is 100% accurate. It can be right in that ballpark.
I think that 10 is probably the new 5, right? It's right around there typically.
Wow. Yeah.
And that 10, that's the new 5, Michael. You're I don't want to say confident, but you're leaning towards that's the new baseline.
I think that's the new baseline. I do think materials are going to come back a little bit.
Okay.
I do. In fact, that same fence vendor said to me he just had a 3% reduction, which wasn't significant, but in aluminum, he saw a little bit of a pullback, and he hasn't seen that in 2 years. So
heading in the right direction. Okay.
Yeah, we see wages continuing to appreciate. We see median incomes around 60,000 for last year for the state of Ohio. We see a 4% appreciation in 23 and 24. We're looking at closer to being 67 to 70,000, right? Doing that 30% equation, the median income levels, 1,500 to 1,700 in rents is very feasible. Going back to oil and gas and aluminum production is returning to the United States, right? Because now we can use natural gas to fire. Aluminum is the most recycled material. I think we recycle 74% or so of all aluminum in the world, because the purest form of aluminum that we use is a Coke can. So, as we recycle that and we have to get that purity up, goes back into the ecosystem. So those prices, again, as we bring that back to this part of the world, we'll see the cost of that raw material come down over the next decade.
Yeah. And like you said, I think it's, you take a look at, obviously the biggest thing, clients are talking to us now because they're getting their insurance renewals, and the insurance renewals are coming back just sky high, and sometimes that happens when the stock market falls off and the insurance companies aren't getting their return. And it's like, why should I get punished because you're a bad investment manager? But I think we're seeing a lot of it now. It's just because the cost of materials, the cost to replace, and the cost when they actually have fire damage, some kind of incident is just so much greater than it was a few years ago.
You remind me of one more attribute. We don't have floods. We don't have hurricanes, right?
Yeah.
We don't have wildfires. That's another attribute for Northeast Ohio, that, the coast, you always have that danger of, being an operator, dealing with hurricanes, dealing with all those things. We don't.
Yeah, very few natural disasters here in Ohio, sure.
And natural resources, right, with Lake Erie. You guys do a great job of putting up drones on your deals. That's one of the first things we do when we're launching a deal is we launch a drone so that we can show people who are not from Cleveland an overview of the property and the area. And one site that we have near Lake Erie, a gentleman said, "What's that ocean? Where are you guys? What is that?"
Exactly.
That's Lake Erie, and it's beautiful.
That's a true story.
Yeah. Now, well, and again, we're finally taking advantage of a little of that because, I've been doing this since 1983, and so for most of my career, I've had folks come in from Chicago and other places, and they look at what we have done to the lakefront or not done with the lakefront, and they're like, "You guys are the dumbest folks on earth. You deserve your reputation of being from Cleveland, because how can you take this unbelievable resource and underuse the way that you do?" But I think you're starting to see that change, certainly in the things that are happening in Cleveland, Lakewood. I think, the park that they did in Euclid is phenomenal. And the lakefront there, it's a start. It's not enough, but it's a great start.
Yeah, we believe, a lot of the cities that are investing in their schooling systems and their public works, right? I mean, green spaces. Northeast Ohio has tremendous metro parks. We have an amazing system. It's world class, and I think we need to focus on that aspect.
We have more green space per capita than any other city in the country.
Really? I was not aware of that statistic.
Yeah. Well, I mean, obviously we got Cuyahoga Valley, obviously you get National Forest, National Park here, but, like you said, the metro parks and the Emerald Necklace and what it does surrounding, again, I don't care where you live in Cleveland, you're 5 or 10 minutes from a metro park, basically.
That's right.
And they're nice parks, with nice trails and
world class.
You almost feel you're in a rural situation very quickly. So
this was terrific, gents.
I'd be remiss not to ask you guys, turn the table a little bit here for a minute, but we're still seeing some pretty good deal flow, but just curious what your predictions are here over the next 12 months.
Yeah, no, I think, I think you're going to continue to see that. I think you're going to see that for a number of reasons, despite the fact that, obviously, interest rates have increased dramatically, even since the end of last year, beginning of this year. First question we get is how much, a cap rate's gone up, and the answer is no, cap rates haven't gone up. Again, part of that is the supply demand issue. We just have, again, so many folks looking for opportunities that, that they'll take a little bit of a lower yield. And I think part of that is some of the things you guys espoused, which is the back end is way greater than anybody was thinking, right? For 30 years here in Cleveland, it's like, well, you can expect 2% rent growth or 2% capital appreciation, and 80% of your value is in cash flow. So, if you don't buy cash flow right out of the gate, you're stuck. And I think that change. I think you're seeing a little bit of the changing of the guard. Obviously, there's probably more Class A product available right now in Cleveland, Ohio, than you've ever seen in my career. First of all, obviously there's been a decent amount of Class A product, but I think you're starting to see that across the different spectrums, B and C. And so, a lot of longtime holders who don't want to participate in the things that you're talking about, where you're making the capital reinvestments in your property, where you're adjusting to the times, where, again, you're becoming much more hospitality focused than, I'm the landlord, shut up and take it. That doesn't work anymore. So we're going to see some of those, we're going to see some of those folks leave the business. And I think that's going to be great for the marketplace. I think a lot of the transactions and the things that are happening, most of the people at bottom that are better stewards than the previous owners were, they're making reinvestments in the property. I'm still concerned, like others, that, hey, affordable housing, not everybody can afford $1,500 rents, which, again, why I love you guys. You guys are giving them a product that's still affordable. It's higher than the deal you bought, and you've created some value for yourself, but you're creating just as much value for the communities around there because of the way you guys beautify properties, but also, the living conditions you're giving people. So yeah, we're extremely bullish on the state of the multifamily market going forward, both in terms of operationals and rent growth and the stability of it. But again, I think there's going to be a reasonable amount of more velocity than in the past.
That's great.
That's my crystal ball.
Gary Cooper's crystal ball.
There you go.
Well, gentlemen, we're at about an hour. This has been a pretty fantastic conversation. Michael, Bhavin, thanks again for your time. Listeners out there, both Michael and B are very active on LinkedIn. You can find them there. Green Harvest Capital website, ghc-lp.com. You can get in touch with the team via the web. Guys, once again, thank you for being on the podcast. And here's to the next deal.